Good afternoon, everybody. This is the first time we are doing this particular program, and quite a lot of new work has gone into what I'm going to present today. The title is Mutual Funds or Stocks. This is something that a lot of people ask us. The two or three the most common questions people have are: should I go by the fund route or by the stock route? Which stocks to buy and which funds to buy? Obviously, that's what everybody would like to know. And the third thing everybody wants to know is, irrespective of where the market is it a good time to invest? When the market is down, they're very terrified. So the question is it a good time to invest? The sub-question hidden inside that is that, will the market fall further? When the market goes up, is it a good time to invest? The sub-question hidden inside this, it's already gone up so much. Would I make a mistake jumping in now? So no matter where the market is, if it's not going up, you would see headlines in Economic Times saying gold has gone up 10% in the last 3 years. Stocks are down. So those things play on our mind and we say, is it a good time to invest? So no matter where the market is, if it's crashing, we are terrified. If it's sideways, we are not hopeful. If it's already gone up, again, we are terrified whether they're going to make a mistake or not. As I keep saying, we should avoid all of these issues because timing is not very important unless you really want that extra bit of returns. For an average person, it's fairly easy to choose to select a path which way to go, and we have sort of sharing this particular direction for a long time, for 5 years now, in different manner, different forms. I've been sort of explaining what is to be done. This presentation is quite interesting and quite new, and we are very happy to share this with you for the first time in Mumbai. We've done a version of this in Pune a few weeks ago, but I've improved quite a bit on that subsequently. I shared with you what investors normally ask, and this is what they normally do. Okay, here is a chart of Sensex. I'm going to share with you now a bar chart of mutual fund inflows. There's a very clear pattern over here. Anybody who's watching it very closely would know that I've already circled two. Anybody watching this chart would very clearly see that I've circled two areas where the maximum amount of participation. Anybody looking at this chart would know that the investors have participated the most at a previous market peak, which is over there. And then when the market started moving sideways, they have sort of got out in a hurry, or they have sort of kept on selling. What typically happens is that since bulk of the investments come in fairly late in the bull market, there's a lot of nervousness when the market falls, and then when the market starts rising, get me out at any price kind of a syndrome takes over. I've spent 4 years and I've got no return, so I want out right now. Once that happens and the market moves a little sideways, it's time for the growth cycle to kick in, either investment cycle or a growth cycle or some good news. It's very simple, that you have a series of bad news and you're going to be followed with a series of good news. That's the way life is, and that's the way market is. So in this case, it was huge expectations. I'm not going into the details of whether those expectations are correct or incorrect, but huge expectations around the new government and the market sort of shooting up. In this case, once the market goes up, huge amount of investments started coming in. I read the other day in the paper that in the last few months, the investments that are coming into mutual funds in few months itself is equivalent to last 10 years of investments. I'm not sure if this figure is correct or not, but you can add up all the bars. It looks incredibly like a tide flowing into the market after the market has already gone up. There's a lot of explanations for this. There's a new class of investors I read in Economic Times who would not sure that they can buy stocks directly, which is a topic which is relevant to us. They lack skills, time, experience required for investing in shares. They want to rely on professional fund managers. All this is valid. This is valid at any time. But the question remains, what are they buying? Very interestingly, and this is a point that had become very important in the US many years ago, and this is going to happen in India too. The number of equity mutual funds are 352 already, and they'll keep increasing because it's very easy to launch a new fund, especially very tempting to launch a new fund when the market has gone up, because people want to invest in, for 10 rupees in a new fund, irrespective of whether the underlying shares have gone up or not. So a lot of closed-ended funds came up, and a lot of new NFOs have started coming to the market right now. So you can very well be certain that this 352 is slowly going to inch up to 400, 450, 500. In the US, the number of funds are more than the number of stocks. And we've already reached a situation where the number of funds are more than good quality stocks. At least there are 6,000 stocks listed, but who cares about 6,000 stocks? A majority of them do not earn a return on its shareholders' capital that would justify our investment in them. So if the bank is lending to businesses at 12%, 30%, or 14%, if a company is not able to earn more than that, it is doing a very poor job. And companies that are earning more than 12, 13% are very few in number. They're not more than 200. I've extended my list to 11%, and I get a figure of 350 stocks or so. Let's say 300 quality stocks and 352 mutual funds. The question and the problem and the issue remains, how would you choose? In principle, there's no difference between stocks and funds. A lot of people try to tell you go by the fund route if you don't understand stocks, which is okay, fine, which is absolutely valid. But I've already posed the first question. If you can't choose stocks, how would you choose funds? And vice versa. But some amount of technical knowledge is definitely needed. It's not so easy. Both are volatile on a day-to-day basis. The reason we get to know and discuss more about stocks is because stocks, there is a ticker for stocks. There is no up, down, minute to minute, 5% up, 3% down kind of thing on NAV. NAV is calculated at the end of the day. You don't even get intraday NAV. I mean, you can calculate if you want to, but it's madness for any mutual fund investors to even ask to calculate intraday NAV. Whereas stocks are being discussed every second, and there is a ticker, as I said, which keeps running. So we get to feel as if the stocks are much more volatile and mutual funds are much more safe. They are not. Now, both fall. When they fall, both fall very sharply. And I just happen to sort of ask these questions, and I come up with a very interesting answer. Here is a chart of a fund or a stock, and the next chart also of a fund or a stock. We don't know which is which. They all both look similar, isn't it? In fact, the first one looks more like the stock, and it isn't. That's HDFC Top 200, and the second one is a blue chip company of India, which is Infosys. Forget about which has gone up more or less or whatever, but they look very, very similar. When they fell, they both fell. When they went up, they both fairly went up in tandem. Funds are wonderful products, and there are lots of interesting features in funds which we cannot ignore, and which is very, very important for an investor who is possibly investing for the first time, investing less, and so on. And here are the reasons. You have absolutely no time to even look at stocks. Very often it happens that we get a email from somebody who is 60, right? Moneylife Foundation member or magazine reader or whatever. 60, 65, 70. Not only is he managing his own money, but he's managing the money of his son or a daughter as well. And they're so busy, they don't even know where the money is. They just are interested in earning and possibly spending and partying. So in a situation like this, where you have absolutely no time at all, which is what is happening to a lot of young people, funds are the right route. No interest. I completely sympathize with this. There are 20,000 more interesting things in the world rather than figuring out NAV and return on equity and company management. Finance is boring. There's a reason why it's boring. It's sort of the best of finance is unexciting, and people want some change every day and so on and so forth. No one to trust. The other day there was a lady in our seminar, and she kept on repeating, wonderful presentation, great, but I don't know whom to trust after having come to Moneylife Foundation. So I said, you won't like the answer I give, so I won't give that answer. Sure, I sympathize with this. 50 people may be trusting me, but what about the 5 lakh people who are outside? They don't even maybe know about me, or they can't attend a conference seminar like this. And if you've gone through one cycle, which is where you invested in 2007 and you sold at 2010, having got disgusted with negative returns, that is losses, being nicely put, or meager profits, you don't even trust yourself. That nobody would believe that, nobody would admit that, but in a heart of hearts you feel that, I don't know, this is not for me. And this is a very important point. For an average person may just not have the money to invest in stocks. And this is something that is not highlighted by the media. It's a very, very practical and important issue. To invest seriously in stocks, you need to sort of diversify a bit. Say you need to invest in about 10 or 15 stocks. May not be at the right time, but fairly closely to each other. If you stay exposed to one stock, you're taking a huge risk. If something goes wrong with that company management or the external environment or something in that sector, it's not done. It's a very foolish thing to do just to buy one stock. To buy 10 stocks, today all high quality stocks are in 4 digits. Whether it's HCL or whether it's Infosys or whether it's TCS, MRF is some 36,000 rupees or so. It's a very good quality stocks. He refuses to either split or give bonus, and he's been like this for the last 25 years. I know, Mr. Mapillai. And so the stock is valued at 36,000. If you buy one stock, you need 36,000 rupees. And that's an extreme example, but any good quality stock, Nestle is 6,000 rupees, for instance. This problem is just going to get worse and worse and worse, because India has this funny concept of par value. It has to be at least 1 rupee. So you issue a bonus and you do a split and it becomes 2 rupees and then it becomes 1 rupees. Good quality companies keep growing. When they grow, they earn more net profits. When they earn more net profits, the share price goes up. So 1 rupee stock can become 6,000 rupees someday. What happens then? 6,000 can't be, you can issue another bonus maybe, but you can't split the stock anymore. So at some day, Indian government will have to think in terms of not having a par value, but that's for them to decide. But net problem is that if you want to buy 10 stocks, you need 50,000 rupees maybe, or 40,000 rupees to start with, if you have to diversify and buy quality stocks. And in a situation like this, a lot of people look around for, double-digit stocks and stuff like that. And that's risky, because you're not focused on quality, you're focused on the number. So for all of these reasons, including the fact that it's your first day investing and you don't want to take a chance, or first year in investing, mutual funds are absolutely fantastic, wonderful. I'm all in favor of them. But a lot of people come up with reasons to invest in mutual funds which are not correct. For instance, for fund industry itself says that we offer you a lot of choices. So you can choose between sector funds, contra funds, target date funds, international funds. I'm just giving only a few examples. There are hundreds of them. Like ice cream or shampoo flavor, they just hundreds and hundreds of different kinds of. It's like sold like a consumer product with different variants, like a Dove soap or a Lux. Now, we don't need all those variants. They're not good enough. They're bad. In fact, international funds, we were against. We were proved right. When we launched the magazine, in the second issue, we wrote, don't buy contra funds. UTI was advertising contra funds in that issue. They stopped all advertisements thereafter. I didn't even know that they were advertising contra funds. But contra funds was something that was very popular at that time. Everybody was launching. There's no meaning to contra funds. You buy good stocks and hold in a portfolio. What contra are you playing? So, sure enough, they have not done well. sector funds worse because you're fully exposed to just one sector. It goes down, you had it. I mean, the whole idea is to diversify, not try to be over smart and guess now automobiles is going to do well, or FMCG is going to do well, or banking is going to do well. Nobody really knows. Even the fund managers don't know, which is why in a large cap fund they are diversified across so many sectors. If they knew, they'd be concentrated within that large cap funds in specific sectors. People also say, unlike Satyam, human mind always looks for one negative example and tries to blow it. So you ask people to buy stocks, they say, look at Satyam, as if there is no other example in the world. So, unlike Satyam, funds don't go bankrupt. Okay, funds would have gone bankrupt in 2008 but for SEBI's strong intervention, but that's a different story. That's no reason, because your whole objective, if you're not buying funds, is to buy good quality companies across sectors. Several of them. One goes bankrupt, maybe Nestle goes bankrupt, who knows tomorrow. But you would have invested in 14, 15 others, and hopefully your entire portfolio is not going to go bankrupt. Liquidity, you can redeem anytime. It's not such a major issue according to me. You can sell the stock anytime as well. Professional management, in principle, yes. But I'll have a chart subsequently to say mutual fund industry as a whole is run very professionally is one thing. To take advantage of that is quite another matter. I have no doubt that they intend to be very, very professional, but the performance is a different story. For beginners, I said funds are the right route. No need to select funds. No need to select stocks. Buy index funds and Nifty ETF, for instance. Now, what kind of returns would you have got if you did this? Nifty, this is total return index. There's a difference between Nifty that you see, which is only a price change. But if you bought the shares of the Nifty companies, you would be getting dividends as well. And you would be reinvesting the dividends, hopefully. So the return that you get not only from the price change but from the dividend as well is called total return. It is capital appreciation plus dividend, both tax free. Nifty total return index would have given you almost 21%. This is annualized return from June 2003 to May 2015, which is about 12 years. 12 years, 21% compound. This is one of the great periods of investing. This is not going to be replicated in future, so don't go by this. But you would have a choice of buying Nifty. If you bought Nifty ETF, you will get a return which is close to total return index. Or you could buy ICICI Prudential Index Fund, which came pretty close to the TRI, UTI Index Fund, BSL, and so on and so forth. As you go down, the returns are a little different from the index, because either they try to optimize, which means instead of getting fully invested with Nifty stocks, they try to keep 15% in cash. They say that if there are redemptions, we have to pay out and so on. So the returns will vary. Some of them, like LIC Nomura, even buy non-Nifty stocks. So not only do they try to time the market, they buy non-Nifty stocks and the results are pretty bad. So if you're buying index fund as a beginner, it's wonderful. Buy Nifty ETF or buy one of the top 2 index funds, and this is roughly has been the return for the last 12 years. It will not be as good in future. We will certainly get about 12 to 14% over the next decade or so, all tax free. And the beauty about this is that you just buy that fund and forget about it. You don't need to change. You don't need to pick stocks or decide on which funds and so on. For those who are interested, choose from top performing funds. That is only large cap and only mid cap. The large cap includes equity, diversified, multi-cap, all different flavors and things like that, and a little bit of mid cap. So you probably would have 30% or 40% mid cap and the rest in large cap, and that's it. Nothing else is needed. You need to choose between this, of course, but as a category, eliminate 90%. Not 80-20 principle. 90-10 principle is in finance. 90% are irrelevant or harmful, or both. Only 10% is good. You need to pick from there. Sorry. Yeah, multi-cap, flexi-cap, or whatever to say. 10-year returns of top 5 funds. I've just given it by way of what kind of returns you could possibly expect. These are based on historical performance. It says nothing about the future performance, but usually funds which are in the top 25 percentile, top 25% of the funds usually tend to keep performing or staying at that top level. So while it's very important for you to decide which one, if you choose, if there are, let's say, 100 funds, and if you were to choose between top 10 of those, at least 6 or 7 of those will keep repeating. They are the good boys in the class. They are between first, second, third. They are not going to go down to the bottom of the pile over a period of time. Don't choose a period like a year. It doesn't matter. Within a year, yes, HDFC may underperform or Reliance may outperform, or all of these things are going to happen. Take any reasonable period. And by reasonable period, I mean 5 years to 7 years. Any rolling 5-year to 7-year period, the good guys are going to always be on top. Somewhere on the top. It's not, as you can see, 22.75, 21.99. It's hardly any difference. Okay. Next time, maybe Birla Sun Life frontline equity is number 1. So it's somewhere there. Very easy to find out. Go to Money Control, Value Research, choose a period. Don't choose anything that's less than 5 to 7 years. 7 years preferably. See who are the top. Choose any other period. Do this over 4-5 periods. See the ones that are coming more frequently on top, and that's your good fund. That's it. Nothing else is needed for you to sort of choose. If you want to more than this, the cost benefit is not going to work in your favor. You're going to spend more time, and what you're going to get out of that is not going to be significantly better. You're not going to discover gold. You only discover these funds. These are the schemes that keep coming up here and there. The best thing you can do is that, having selected 4 or 5 of these funds, just go into the portfolio and see if it's possible. Spend a little more time to see that the portfolios are not similar. I'll give you a wonderful example of HDFC top 200 and HDFC, and I'll show you how to do that. Ensure that the portfolios are, ultimately they'll be common stocks. Again, in market, everything is a question of approximation and probability. There is no hard and fast and pinpointed rule and conclusion anywhere. So it's not that though there is Infosys in 3 different funds, doesn't matter, it's okay. Question is whether 50 to 60% of the stocks are similar or not. Within one fund house, you will find that. So if you choose Reliance, and if you choose ICICI, and if you choose HDFC and UTI, this, I'm not recommending them, by the way. I'm just saying that I have noticed that their styles are different. So it's most likely that you're going to have different kinds of stock, at least 25 to 30% in each of these funds. Now, that's for those who want to invest in funds. And I've explained this multiple times. All of the other details that you need to know are all there in the videos which I've put up in YouTube. Now I'll move to the issue of whether to move to stocks and why. 2 of the biggest issues that I have about funds are costs and returns. And this is a central point about investing. Are you spending too much money to maintain that flat of yours so that your returns go down? Are you going to get enough of returns from that flat to justify spending that money? That's on real estate. Same thing about stocks. Mutual funds charge you 1.9, 2, 2.3, 2.7, 2.8. It varies every year, whether you make money or not. So if you give them a lakh of rupees, you're going to be charged 2.8% of that every year, or 2.3% of that every year. The fund is very large, the charges are a little less, whether you make money or not. This cost drags down the returns. Let me explain how it works. Now, this is the growth of a 10 lakh portfolio over 5 years post cost. Okay. Between a stock portfolio and a mutual fund portfolio, I have assumed returns which are identical. And yet, if you notice, the stock portfolio has hugely outperformed the mutual fund portfolio or the same rate of return. Doesn't matter what the rate of return is. Maybe it is 15% or so. You would notice something quite interesting. There are 4 legends there. Stock portfolio, how much is the value? Mutual fund portfolio, how much is the value? Trading and demand charges, mutual fund expenses. I have only 3 on the chart. Where is the 4th one? So the 2 portfolio values are there, mutual fund expenses are there, but the 4th one, which is trading and demand charges, just doesn't register in the chart. It is so little. 2.3% impact can be gauged not only with the bar chart, but with an alternative, with the option of buying stocks and noticing that it doesn't pinch you anywhere. I can't even register it in the chart. It's so little, roughly 2,000 rupees per annum. Now, where is the funds? Where do the funds become expensive? Gross return is about 17%. Let's say fees are about 3% or so, and net return is about 14%. Now, this is a yearly cost of a 10 lakh portfolio: 23,000 and 2,000. All right. If you take this same story over a 25-year period, 31 lakhs goes in mutual funds and only 52,000 in stocks. Impact of cost. If you put these costs in the fund, what happens? We try to correlate returns and costs. Do funds which charge you higher costs, do the returns go down or not? That would be a very nice example, very nice way of correlating. And this is exactly what has happened. If you see this is how the costs go up, and if you see how the returns go down. Just check. I'd mentioned that I'm going to come back to the issue of professional management, which I said is not such a strong reason by itself to buy funds. This is a 5-year return of 168 schemes which were there 5 years ago, as on 30th April 2015. This is a real life story of what actually can happen. Not this fund or that fund, but across the board what could happen to funds. Top 15 schemes gave you a return of 21%. All the schemes on an average, immediately the return drops to only 13%. The average of all the schemes. Bottom 15 schemes minus 5%. Same period. 5 years, 168 schemes. 168 schemes have 168 fund managers. And all of them are IITIM and all of that, from top 168 jobs only. Okay, there are fund managers. Everybody wants to be a fund manager. All financial analysts want to manage money. That's the dream. And only 168 jobs in a nation of 1.25 billion people. And see the variation between them. All of them are owned by top quality companies, quality owners. It could be foreign, Indian, doesn't matter. It could be JP Morgan, could be LIC Nomura. Nomura is a giant. One of those will be probably Nomura. Now, they're all the same, and you meet them, they're all very smart people. They know exactly what to do. They're fantastic with spreadsheets. Excel is like so easy for them. And yet, every time when I look at this variation, I ask myself, how is an average person going to believe if he has bought some of those by listening to X or Y? Because there are multiple ways one can get advice. You can get advice by somebody on TV, by reading, a friend, anything else other than your own hard work, right? So if somebody had bought any of those funds in this area, he'd never buy stocks in his life. So professional management is not something that I would pay too much of a premium on. Yes, I would pay premium for performance, which, as I said, go over 10 years or 7 years or so. Now, to take forward the way I've said choose your funds, 5 years ago, let's replay what we could have done. 5 years ago, we have looked at these 5 stocks, and once through this choice, I'm going to move to from funds to stocks. 5 years ago, these were the top 5 funds. Okay, HDFC top 200. Sorry, 30%, 30%, 30% again, 29.98, and Birla Sunlife Frontline 28. Hardly much to choose from. They're all neck and neck. They're all fantastic companies, great. What do? We choose from this. Okay, but the problem is, you choose from this, you get the good and the bad as well. These funds over the next 5 years obviously won't do as well over every 5-year period, and they give you a return not bad still, but 12%, 12, 13%, 13%, and so on and so forth. So your choice was more or less not bad. It's not minus 5% category and so on. You got a fairly good return in a period which was, the market wasn't doing too well. Now, the problem is that these funds had all kinds of stocks. There were stocks in cyclical business. There was Reliance Industries in it. There was Jindal Steel and Power. All kinds of stocks were there in their portfolio. Let's look at what were these stocks. The top 5 funds. Look at the top stocks in these top 5 funds. These were the stocks. I have marked some of them in pink for a reason. 5 years ago, if somebody had asked me to choose from these are the ones that I would not choose. At any time, if you wake me up in the middle of the night and if you say Reliance Industries or State Bank, I would say no. No matter what my mental state is. Okay? These were the stocks in the portfolio 5 years ago. Now, let's look at the returns of all these stocks. I have 2 parameters over here. One is return on net worth, and that will give you an idea of why I would not choose these stocks. That is, how much return the company is making on our money which is invested with the companies. The second return is actually the market return, where the stocks were at that time, and 5 years where the stocks went. SBI gave a return of 3%. Reliance is actually down. Okay? And of course there is Jindal Steel and Jindal Stainless and BHEL and all of that. Clearly, all kinds of stocks were there in this portfolio, not just high quality stocks.
This return is for which 5-year period? This is for the
Same.
Up to 2010.
Yeah.
5 to.
Yeah. Now, no. Those 30% return was from 2005 2010. When we are in 2010, we chose those 5 mutual funds. Those mutual funds had these stocks in 2005, and this is a return over that period. Mutual fund returns are 12%, 11%, and so on. These are the returns of the stocks in those funds. These are top stocks, almost covering 75%. So I took 75% by weight, by value for all of these funds, put them together. This is eliminated the common ones. This is what I got. Now, my question is, can we do better than this? And I'll give a theoretical answer and a practical answer to this. Let's look at the top stocks once again. These are the ones which are there in the portfolio. Okay. And I picked the ones which I would like. And what would happen to my portfolio? This is quite dramatic. Average of top stocks in top funds. I don't know if you noticed this. Notice the average figures below. In this entire period, Nifty itself has gone up 9.16%. And the average performance of this entire stock in the portfolio is 9%. These are the top stocks chosen by mutual funds, for which they're charging you 2% plus. So if you had bought Nifty, it's a beginner would have bought Nifty. He would not have to bother about choosing funds. He would not have to bother about choosing stocks. He would do as well as the average of this. Of course, the fund manager is a little more smarter, so that's why he got you 12% and 11% return more than the Nifty in two ways. Maybe invested a little more on the better performing stocks. It's a weightage that they give. This is equal weight. If you put same amount of money in all of this is the return what it would be. But net in 5 years, the top stocks in the best performing funds, 9.16%, 9% return. Nifty is 9% return. Now, I saying that I would not have chosen these, the pink ones, and the rest I would choose. Their choice, okay? I'm not even saying I will choose some other stocks. My universe, my sample is only their choice. I'm just eliminating ones that I don't like from their choice. That's all I've done. What would be the performance? It's quite dramatic. As I said, I repeat, average was 9%, Nifty was 9.6%, average of the top 5 funds was 13%, and our portfolio, minus those pink ones which I don't want to choose only, is 17.74%. Significantly higher, 5 percentage points higher than somebody who's being paid crores of rupees to manage your money. Not bad. Now, you can always turn around and say, this is all hindsight. You know what performed, didn't perform, and you eliminated based on what you know. You didn't apply any method or anything, and you know Reliance has not performed. I don't trust you. Fine, don't trust me. This is what you have actually done. It's a cover story based on the same principle. Live example, not hindsight. Look at this. This is the formula applied in this cover story. The story came out in December 2013. Same process. Best stocks from best equity funds. You can go and pay 99 rupees only and read it on the website if you're not a subscriber. How have we done? This is a portfolio. It has done 39.5%. Everybody also has done fairly well in the last 1.5 years. So, top 35 schemes. But this method has beaten 92 of the 97 schemes which we had picked up. So, it's possible. How is it possible? I'll show you. Funds charge us 2%, 2.5% and so on. According to me, they should do much better. If HDFC mutual fund is given 21% compounded annual return, they should have given 27% in my view. If they have done 12% in last 5 years, they should have done 17%, 18% in my view. At least 3 to 4 percentage points higher they should be giving, because they're charging me that money. Okay. Now, just go back to all that I'm saying. If you were just bought only the stocks that HDFC mutual fund has bought, same stocks, it's published every month, you can save that 2.3%. Straight away you can add that back to your portfolio, right? Because charges of demat is nothing, and today you can buy stocks for 20 rupees at Zerodha. So it's a negligible cost for somebody who is having 1 lakh portfolio. Also 20 rupees is what? Vada pav. Okay, so you save that 2.3% straight away. So I'll pay you 2.3% for what? For 3 things. 1, for stock selection, not for selecting Reliance, not for selecting BHEL, not for selecting State Bank of India of the world, for selecting a Lupin and a Dr. Reddy, well known, but you should know that these are expensive stocks, but they will go even higher. That is something that you should have known, right? 1. 2, if at all, for the crores of rupees that they're charging us every year, and the amount of money they are making on their own invested capital, it's 200-300% by the way for some of these funds, because to run a fund, it doesn't need that much of capital. And once the fund goes to a certain size, the incremental cost is nothing, and every month all this 2.2% business is coming in every month, irrespective of the performance. So I would expect them to get out of the market when it's expensive, get back in to the market when it's cheaper, or even within stocks, get out of certain stocks when they become expensive, like Symphony. I'm just giving an example. It just shot up, became 2,600. Now it's back 2,600, now back to 2,000 or so. I would expect them to get out of these stocks and get back in. So smart buying and selling is what I would pay for, most certainly. And that will add another 4-5 percentage points. If they tell you, we are not into buying and selling, there are two issues to it. A, they are lying, because funds keep churning the portfolio. There are some funds which is with an 88% churn in the portfolio. 88% of the stocks are new or fully changed within 1 year, whereas you are supposed to hold for the long term in their funds. And third thing, exposure weights. You should know, for instance, and that's why I'm paying you more money, that X stock will do better than Y. So you will buy more of X and less of Y. This is called weights. If you can't run an equal weighted portfolio, if you were to run an equal weighted portfolio, you will have 30 stocks, 3.33% each. Only 50 stocks, 2% each. All right, but you have chosen to put 7.5% in something and 3.98% in something else. Yes.
Individual investor, I don't have the advantage of taxation which the mutual fund has.
Why?
No, because they can buy and sell and they don't get taxed.
I'm not asking you to buy and sell. I'm saying my paying money, a higher charge to them for an investor who's serious, who's interested in managing his own money carefully and smartly, for them to pay 2.3% to a fund manager, this would be the expectation. Let's see what they do on this score. Stock selection. Most funds have the similar kind of stocks in the portfolio. Why? Because they want to outperform the benchmark. What is the benchmark? According to SEBI, when you launch a new fund, you have to say what is your benchmark of the fund. You have to choose a publicly available index. Sometimes it's private index also, calculated. Like Reliance Entertainment Fund is benchmarked to an index which they've created. So you have to say, I want to be compared to Nifty, or I want to be compared to BSE 200 or whatever. So that is your benchmark. Once you do that, then the funds would go and buy most of the stocks in the benchmark, so as not to move too much away from the performance of the benchmark. If you move too far away, the salespeople will come and tell them, people are asking, how is it that Sensex has gone up 5% and you are down 2%? They don't want to take the chance even for a short period. Now, as many as 86 of the 200 actively managed diversified mutual funds have Reliance in the portfolio. One of the worst performing large cap stocks of the last 5 years. I would not buy this stock in any case. Forget about 5 years, 2 years, 10 years. Why do funds buy Reliance? Because Reliance is there in all benchmarks. So whether it's to 1% or 5% or 3%, they have to put the money in Reliance. It's like a compulsion. This is not stock selection. This is not finding out a great company that is going to grow over a period of time and give you great returns. This is playing safe with your money. And Reliance is down 21% in 6 years from May 2009. These two funds give you a great insight into how funds actually buy their stocks. HDFC Equity, HDFC Top 200. See the stocks in the two portfolios. It's the same. Identical stocks, the weights are only a little different. 37 stocks are common. 85% of the portfolio is common. 85%. Two different schemes. This is not stock selection. The fund manager of one and the fund manager of other are just thinking alike, identically. And thinking in terms of all index stocks. Thinking in terms of State Bank, ICICI, Larsen Toubro, Infosys, Maruti, BPCL, Bharti, Tata Motors. All index stocks. You might as well buy Nifty and save that 2.3%. Evidence number 2. The performance of these two funds vis-a-vis BSE 200. This is called indexing, closet indexing, disguised indexing. You are buying an index, but you are pretending that you are actively managing, and please pay me 2.3% and so on. So I proved my first point, that they cannot be demanding 2.3%, 2% from me for stock selection. The stock selection is nothing great to write about. I've already explained what I would have done, and I've proven it in a publicly available article, and now I've proven in the portfolio of HDFC just as an illustration. Point number 2, buying and selling. To create more long-term wealth, frequent buying and selling is not needed. There's no doubt about it. But what is definitely needed is to reduce your exposure to stocks once in whenever, 5 years, 10 years, when the market becomes very, very expensive. Market became expensive in December 2010. Market became expensive in January 2015. Market became expensive in January 2008. These are not with the benefit of hindsight. These, I can tell you exactly next when the market becomes expensive. It's still expensive now, according to me. This is the time, based on your research, you should be reducing your exposure to stocks, if you have not already reduced. But funds don't do that. Most of the funds are now 90% invested. For the last 5 months, market has been expensive. There's only one fund which has taken the trouble to trim its exposure. 2. One significantly, which is Quantum, and one ICICI fund, which is second. Funds don't do it. They don't even try to time. And by timing, I don't mean day trading. I don't mean trading over the week, month, or whatever. I mean occasional trimming of portfolio when you are very clear either the stock is outperformed or the market is overvalued. They don't even try to do any of this. Third, look at these two examples. I ask a question, I get very interesting answer. I asked Jason, do a comparison between State Bank of India and State Bank of India blue chip equity. And let's see what they did. I mean, nobody has to do anything to State Bank of India. It's a market-based thing. It's a stock. It fell. State Bank of India blue chip fund managers could have sidestepped this. We could have had a situation where it both falls, but it falls a little less or substantially less. It goes sideways somewhere. You move out of stocks. They are not able to do this. What more evidence do you need that even at a time in January 2008 when the market has become horribly undervalued, over the course of the next 3 months, the US economy, US financial markets were collapsing. Oil prices started falling in after July. At no stage has the SBI blue chip equity fund manager been able to do significantly better than SBI, the stock itself, which went down sharply with the market, and so did the blue chip equity fund. Third, which is weights. So my first point was stock selection, second point was timing, occasional timing, third point is weights. There is absolutely no scientific basis for this kind of a look that you see in a portfolio. You go to value research, any portfolio, anywhere you will see these weights, meaning these are the exposure. So 7.6% of the portfolio is exposed to State Bank of India equity. Why 7.6? Why not 5? Why not 3? Why not equal? Why not say, I don't know how the stocks are going to perform in future? Nobody really knows. You can have a little more conviction about one stock or the other, but having picked a stock, how is it that you're sure that SBI it deserves a far greater exposure than, let's say, ITC or HDFC Bank?
See, I can just say, here, now, I think the weight of SBI in Sensex is only about 3% or so, if I'm not mistaken. So here, the fund manager is an active call.
Right.
He has decided that, so he is highly overweight in SBI. He is just at market weight in ITC. Now, there is some thinking behind it. See?
What is the thinking behind the next one?
No, in the case of Reliance, you see Reliance weight in Sensex
5, 3, 2, 1. This is a toss of coin. I have done enormous research to find out how to weight a portfolio. Finally, it's your gut feel. There's no scientific basis for this. If there's no scientific basis, you should equal weight your portfolio.
No, you cannot. You should be at market weight. If you don't go, if you are equal weighting.
If you selected stocks from index, and if you have done a market weight, you will get a performance of the index minus 2%. Who's going to give you money for that, and why? So in any case, then you have fallen foul of the first two conditions, which is A, stock selection, B, timing.
No, see the logic. For example, one fund manager, Prashant Jain, he once explained that he has gone for rate sensitive equity stocks, equity sectors. So there is some thinking behind it, which may be right or wrong. It may not turn out.
I'm sure there's thinking behind this. All I'm saying is that there is no published research to how to weigh a portfolio. I'm not talking about Prashant Jain. This is only an illustration. He may be right, he may be wrong. I have no doubt about the fact that sometimes he'll be right. But let's put it point blank. My selection of stocks, as I've explained, by eliminating companies on a simple criteria, and that is a well-known criteria. Everybody agrees you should buy high-quality stocks. By not buying a BPCL and a Reliance and a SBI, our stock portfolios perform so much better. And we do this every 2-3 years we do this. The same thing had happened earlier also, 2-3 years ago when we did this. So if the logic doesn't work, then you have to abandon that logic, first of all. More importantly, it's not about Prashant Jain. It is about an approach, a robust approach. The approach has to have a justification. It's not about how you apply it. Approach to picking stocks is very robust. You have to buy good quality stocks at reasonable price. You can define it the way you want to, but this approach is the correct approach. This is the approach from Warren Buffett down to everybody, whoever has bought stocks and made money on the long term. This is our approach. It has worked. It has worked for everybody. So there is enormous amount of data, information is available of what happens when you buy good quality stocks at a reasonable price. You can be 5% here or there, but no doubt that this is the correct approach. There is no information anywhere how to construct a portfolio with different weights. And this is not a simple thing. If SBI doesn't perform, and it has not performed so far, and if ICICI Bank doesn't perform, and Infosys is certainly not the best choice among the IT sector, and L&T doesn't perform, and then there is Reliance, and nobody knows what Tata Motors does in the rest of the world, which is what dictates its profitability. This is exactly the wrong portfolio to have. It doesn't have pharmaceutical companies at all anywhere. It doesn't have any other private bank. According to me, Kotak Mahindra Bank may do better than SBI.
Axis Bank and Pharma.
It's not there. FMCG is missing. Axis Bank is missing. Pharma is missing. You can say these are expensive. Yes, they are expensive. Asian Paints has always been expensive in its entire lifetime. It's never been cheap. Hindustan Lever is never cheap. They won't be cheap because they earn 40-50% return on capital. They are not like SBI, which has exposure to Kingfisher. What management? So this is a third reason why performance goes down. So I'm concluding point of my presentation, and after this I'll take questions. Buy stocks of high quality. It's as simple as that. You can pick them from the mutual funds portfolio itself. You can ask me how to pick stocks, and there are 6,000 companies and there are 300 companies. Share your database with me. None of that is not needed. Take top 5 or 6 of these funds. UTI is a very good fund, UTI equity fund. Anything that Anup Bhaskar handles, good. Anything that Prashant Jain handles, good. Anything, some of the Reliance funds are good. ICICI funds are good. Take all of them, all the stocks in one place, in one Excel sheet. Find out against them what is the return on capital employed. Choose the top 20. You're not going to go wrong. You're going to beat the fund managers. I'm quite certain about it. I have done it. You can do it too. There's no doubt about that. And the cost is nothing, which is your demat charges and buying one time. All right. As for selling, the National Stock Exchange publishes a PE of the whole market, price to earnings ratio. It's based on last 4 quarters of profits. If the PE is above 23, 24, the market is expensive. If the market is expensive, think of bringing down stocks that have gone up a bit. Okay. Remember, it's all a game of probability and approximation. Our whole approach should not be to maximize. Our whole approach should be to be satisfied that A, we have got tax-free gains, which is far higher than bank interest. B, we would have beaten 60 to 70% of the fund managers in any case. So last extra bit of money you haven't got, you sold early, the stock has gone up, train your mind to be happy. In any case, that is, you know that it's all about probability and approximation, as I mentioned, and nothing more is needed. For your inspiration, one chart, one last thing. This is a chart of a stock. If you put 1 lakh in it, in 1990, it would have become 1.25 crore. You can see that over there. It has fallen a little bit. Why has it fallen? I'm sure all of you can guess. Because of a controversy which might sink the company. Maggie. This is Nestle. You can't even see what the problem is, and it has gone through everything. It's gone through, Rajiv Gandhi's assassination, and then Babri Masjid, and India going bankrupt, and 13% inflation, and .com crash, and 2008 crash, and everything. It's gone through coalition government, 20 scams, all through that. This is how the stock has risen. Thank you very much.
First of all, thank you for this beautiful and very insightful presentation.
Thanks.
There are funds apart from diversified equity funds. They have a problem of mandate. Once they come with 90%, they have to be invested in equity at any point of time. So there are funds, who look at the valuation and they dynamically switch from equity and they go to debt whenever the valuation is high. So that can solve the problem of smart.
No, it doesn't. There are funds like Tata PE equity fund. There's 2 things. One is that method that they apply is not good enough. We've done a lot more work on that, and we found out that whatever published is there in the prospectus and in other places, it shows that they have not studied it very thoroughly of what is overvaluation, when to move in and out. It's not an easy thing to do. I would expect funds to do this because they have the resources to do it. We don't have the resources, but I feel that they have not spent enough of time and effort and energy to figure out how to implement that sounds great, because anytime you look at a chart and Titan has fallen 60%, obviously your mind feels that, what if I had moved out of this stock? And when markets fall, as I gave the example of SBI, everything falls together. So I would say that the first objective of any fund house that wants to distinguish itself ought to be research on timing. And timing can add 5, 6, 7% to your return. It's not something to be sneezed at. Anyway, they're charging us money for that. But they have not achieved it. In fact, we've just 2 issues ago, we've done an analysis of dynamic schemes. We found that most of the dynamic schemes in January were invested at 85% plus. All right, so they don't even they don't care. At the end of the day, it's run very sloppily, according to me. So I find a lot of scope for improvement from my perspective. I don't know what others feel. Second, 2 funds have actually moved to cash, and one of them is Quantum Equity Mutual Fund, which substantially has moved to cash. Almost 60% or so is now in stocks. I think 40% cash they are. And I tried to analyze the impact of this, and Quantum's performance is not significantly better than anybody else on a 10-year period also. Their performance, if the timing was right and if the stock selection was right, they should have added another 5% or so. As I said, we've done a very interesting study for the last 3-4 days. We've been working on it, and we have a timing model. According to me, from a difficult period, which is from April 2009 till now, I think Nifty has gone up some 11% or so. A SIP would have got you 14% or so. IRR is your different calculation, not a point-to-point. And if you could time it based on valuation, you could have increased it to 18% or so. It's what we feel. This is only for this particular period. We need to do the study for others. So Quantum should have been by far the top performing mutual fund, heads and shoulders above anybody else, if the timing worked. So something is wrong there. Either the stocks are not correct or the timing is not correct. Timing of getting back also is very important, not just selling. So it hasn't worked. It's a marketing gimmick.
Apart from Tata, even UTI has a PE fund, Franklin has a PE fund.
Yeah, a lot of them have this.
Yeah.
IDFC had 2 years ago brought a fund which is entirely based on timing.
But it does not work.
IDFC is a new fund. We don't look at funds which is less than 5 years, but I don't think we can check that.
So apart from PE, ICICI has 2 funds which works on P by BV, price to book value.
Price to book value is a completely wrong measure. Price to book value is not even worth discussing. And this is the reason why things don't work.
Okay.
Fortunately, my memory and my experience goes far back. There are funds which close down because they don't work, and they get taken over. They get merged. Those we don't even discuss those returns. The correct approach of research is to bring them into the universe, into the sample, and then see the average returns. The average returns would drastically collapse of the entire mutual fund universe. The example that I gave, which is an average return of 13% or so, these are survivors. If you bring in non-survivors, if you do what is called survivorship bias free, this is biased in favor of survivors. If you bring the non-survivors, those who have collapsed, the returns would go down. So many of these are experiments, price to book value and this and that. When they won't work, they'll merge it quietly with some other fund.
This DSP have come out with dynamic asset allocation. So what they do is they check the PE and then they take the risk-free return, which 10-year GSEC is offering. And then they do the relative valuation.
My point is very simple.
Yeah.
If you do an analysis of 10 years, these would just leap up with returns of 5% higher if they were correct, if they had worked. We are still, when we do the return calculation, we still have the same diversified equity funds coming on top. No dynamic funds becomes number one ever. No PE fund is number one ever. So if you have chosen the stocks correctly, which is common with everybody because choosing the same stocks, and you applied market timing, you got an icing on cake. Everybody would be here and you would be there. Where is that performance?
They started in January 14.
No, that's now. But
And-
all other
yeah.
funds I'm talking about.
And based on their formula, they are still 90% in debt.
Now,
Then even from inception, because the relative valuation of P and 10-year GSEC, when they started, GSEC was 9%, yield was 9%. So the model says
it's a
that,
bond fund.
no, it's a dynamic asset allocation. From 90% to 10%, they can go dynamically.
I'm saying over a period.
Model driven. There is no fund manager
Fine. When
intervention.
5 years later, we'll see whether the performance. Others have failed. Till now, there is not even one example. Money will all go to a person who's earned 5% more.
Yeah, and what about balance funds? They also dynamically change, no? 65 to 35.
Balance funds have to stay 65% plus in
Yeah.
equity to get the tax benefit.
Correct.
So that itself makes them disbalanced a little bit. So I don't see how. It doesn't matter. No big deal. Yes, please.
Yeah.
Devashish, I agree substantially with most of your analysis, but they're all number-based, so there's no disagreeing with it, except in one case, and that is when you seem to indicate that virtually no mutual fund is worth the 2% that you pay. But
No, I would. My point is, let me restate.
yeah, sure.
With absolutely minimal resources
Yes,
and no support of the kind that they have,
yes.
I have actually proven that I can pick and choose from their stocks and do much better than them. So why would they not do substantially better than what they've already done and justify the money that they charge? That's my statement.
That's your statement with which I agree. But there is an exception that you need to make
Sure.
to that, and that is this: that there are certain industries, for example, and say pharma is one, IT is another. Okay, where anybody sitting here will not be able to explain to you what's the difference between this pharma company and that pharma company. But at the same time, what happens is that there are top grade companies there. For example, in the pharma, there's Ranbaxy, Dr. Reddy's. These are not, fly-by-night companies, but they have dropped substantially in price in next to no time, maybe 50% or so at some time or the other. Now, if in those industries, I'm just talking about these two, not the rest, if you by chance make the wrong selection, and Dr. Reddy's and the Ranbaxy would never be treated as a wrong selection historically, and you could have lost so much in no time. Now, in these industries, I
No.
feel... No, in these, let me just make the point. In these industries, I feel it's worth paying the 2%.
No, these industries meaning what? You're getting a basket of stocks which is SBI.
No. I'm talking only pharma mutual fund.
Or the sector funds. I'm not even getting into sector funds. That's a whole separate issue of sector funds. They ultimately, they may work, they may not work. For an average person to buy sector funds makes absolutely no sense. Because you're putting money in one.
No, not to put all your money in sector funds. Instead of buying, say, Glaxo features here or Ranbaxy features here, instead of buying that, to buy that industry, but only pharma and IT. The sector fund only there, not generally. And I can just give you an example. In 10 years' time, that Reliance Pharma has given me a 12 times return. 12 times.
Any other question?
Yeah, I
Yes,
was
please.
curious to know where the retail investors go. Who invests in the mutual funds and who invests in the equities?
Who invests?
Yeah, I mean, who invests in the mutual funds? People like us, retail?
Yeah,
that's
absolutely.
The largest amount, or
Yeah.
is it companies or
In
government?
equity, people like us.
In the mutual funds? And
Equity side. Debt side, companies invest.
And what about the equity market directly, the stocks, as you said?
Equity market, foreign institutional investors.
We don't.
No, we don't. We buy gold and real estate.
So that is something that...
Sorry.
So we prefer to pay the 2.3% and...
If you buy stocks, then you will save that money.
Yeah, exactly. But there's not enough retail investment in stocks.
No. In fact, it's gone down. According to our, not according to our, but according to the publicly available data, number of investors in Indian equity markets has actually gone down.
After the mutual funds came in.
No, even after the mutual funds come up, because a lot of people used to invest in UTI. Millions of people used to invest in UTI. Once they lost money or there was turbulence there, and then they invested in those high yield bonds or government bonds or whatever. No, not government bonds, those Sardar Sarovar and all of those kinds of things, where because interest rates were high, they were giving high. Then they did a put option or a call option. Then they took the money back. So people have lost a lot of money. Then people invested in FD. So slowly, a lot of people have gone out of the sort of stock market.
Did they invest in mutual funds?
Now a lot of people are investing, as you can see. A lot of people are investing. And the market goes up, they invest.
First of all, many thanks to you for making us, Moneylife team make us financially literate, really speaking.
Thank you.
And I'm reading your Moneylife book. I'm reading your Lion weekly statement, as well Moneylife newsletter every day. And you have made one statement right now, saying that we have to reduce the exposure by this time. But reading at your books, reading at all these information, and after the budget, all these 7 icons of the equity market, like Nilisha and all, I heard the 1-hour interview in the TV that CNBC Awaaz. So it summarizes that we should go for the investment in the market for looking at the next 3 to 5 years down the line, and it will give a good returns. So by ignoring this time of reducing the exposure, if we keep investing in a good stock like AI, whatever you have given in the your books, or like Coal India or e-clerks, right? They are the right stocks to keep it in our portfolio for forever. Whether we should reduce the exposure over there, or we should keep buying the good stock by ignoring this time.
Keep buying. Keep good stocks, keep buying.
Or we should not reduce our exposure also wherever we made it. Like for example, Nifty. We bought the Nifty, say gradually, like from 8,500, 8,400, like this.
Nifty is a little different. You need to buy when Nifty P is below 21. As of now, it's 23. So 2 points on 23 is like another 8-9% fall.
It is expected.
No, nothing is expected. Everything is a chance.
Yeah, okay.
It's not, nothing is expected. If it comes down, then you can buy more Nifty. But I don't know who buys Nifty. You buy Nifty ETF regularly? I think the buying stocks directly will give you much better returns.
Yeah, now I'm doing the combination.
Yeah. No, I think you should stick to stocks. Stick to good quality stocks for the long term.
Okay, sir. Thank you. And we have some part of the investment in mutual funds also. Like say 10%, 5 to 10% in mutual funds.
If you can make the transition from intermediate stage to advanced stage and buy stocks, if you can, because ultimately again there also you will have to make a choice. See, if you have invested time and money into stocks, then there's no reason to go back to funds. Funds are only for those people who don't have the time, and they should be happy with a return which is far higher than bank fixed deposits for the long term, and it's tax free. It's great according to me, for the various reasons that I gave, that if you have no time, no interest, funds are wonderful. That is the route for the average person.
If I want to ask one more last question, like what are FDs I am having in the banks? If I shift it to mutual fund as a FD, will it be okay?
Mutual funds, you should never do that. You should have a system of allocating. Suppose you have 20 lakhs, right? And you don't need this money. So maybe out of this 20 lakhs, maybe 20-30% you should keep in FD. Rest of the money should be in stocks. And make sure you buy 15-20 stocks, not just 2 or 3.
How do you identify when you say that good quality stocks are not buying? ROIW is one of the good.
ROCE. And as I said, if you just pick this, they have done all the analysis.
Just take there.
All the top funds, brilliant fund managers have done all the analysis. It's publicly available. You're asking me which stocks to buy. They're the brightest guys in the market. They've proven themselves. They're telling you which stocks to buy. Avoid all so-called cyclical, rate sensitive. I don't even know what they mean. Cyclical, rate sensitive. If you take those 40, 50, 70 stocks and put them in a descending order, it's going to take you
Descending order of
ROC, the highest to the lowest. okay, and you take top 20, you're going to beat all of them. I can guarantee you. Because they all get caught up in all these themes, and that's like a Modi theme, SBI and ICICI Bank. Why? Because the investments will flow. It will be true. It will happen. I'm quite certain that it's going to happen. So investments are going to flow, and these companies are going to benefit, and so that's the exposure, which is the exposure to the India growth theme, as it were, Indian manufacturing, revival of India's GDP, and so on and so forth. So if that is the objective, there's no housing stock there. There's no HDFC, there's no LIC, there's no Repco, there's no Grow Finance. These are the stocks I would buy. Yes, one sec. Take the mic first, let him speak. Yes.
If I select the stocks, if I go to the site of a particular best mutual fund, so-called, top 10, it will give all the investment it has done in different stocks. Now, does it also provide the returns on these individual stocks, or that we have to find out separately?
ROC. How to get ROC?
Returns?
Return on the stock. Let us say I take ICICI, for example, or let us say Motilal Oswal got 35. So I can get all the stocks of Motilal 35 in their site. Getting the stocks which they hold is not difficult, and the returns of those stocks, where do I get the returns on those individuals?
Of the companies, because returns of stock means
individual companies which
you have to search each one by one.
One by one. So there is no ready-made.
Google Finance is doing a lot of. I don't know if they have ROC, but Google Finance or Yahoo Finance earlier, Google Finance now they have put a lot of details in. So you can get the prices, you can get the.
It is to be done separately and individually. For each stock,
a lot of changes are happening every day. As I said, a lot of new websites are coming up which provide this data, and it could very well be that there is somebody where you just put in the names of the companies and they'll give you in descending order what you want and what he wants, exactly what you want. It should be very easy to get.
Then life will be much easier.
So
life is much easier if everybody subscribe to Moneylife subscriber network. I do all the homework.
Thank you.
You just open the MSS.
We are going to do that. For what you want is something that it'll take time because we just short stuff. But what we want to do, obviously for people, paid subscribers, if you put in a name of the stock and you get with the return on net worth management, this, that or the other.
Sir, what is this Nifty Bees ETF?
Nifty Bees.
Bees, what is this?
It's an index. You buy the Nifty and it invests in the stocks. It's exactly like any other index fund.
But it is managed by some private...
Goldman Sachs now, I think.
So
Who? Yeah.
So can you just name 5 stocks which we can blindly buy for the next 5 years?
Not here. Not here. It was the foundation.
Okay, I think.
Hello. When do we invest? Like you said, you select all those mutual fund top 20 stocks. But what is the timing? Like, can we do it today, or when the market is less expensive? How do we time it?
It's better if you do when nobody is buying, not at the time when 17,000 crores is full flowed into mutual funds. Not at that time. It's better, but there are two things. One is that if you buying all at one go, you're pulling out 50 lakhs from the bank and just buying everything today. If you do that, then you have to have a really long horizon. You have to look at 10 years or more to not be disappointed, or rather be very happy with what your performance is. The other option, practical issue for most people is that they have a limited amount of regular surplus. People who are working. So you've got a 25,000 rupees surplus every month. Where to put? For them, life is easier. They need to sort of divide that money every month like a systematic investment plan in given set of 15-20 stocks or so.
Sir, I have a substantial stock in SBI. As you rightly mentioned, that SBI is not doing well. So you recommend I sell and...
I cannot recommend anything here. Okay. My only point...
No,
the
wait for the market to go down and buy some other portion.
No, I cannot recommend that. My only point was that, very simple, at no stage would have I bought SBI. And Prashant Jain has bought. And his performance is not better than mine. That's all I said. In future, we don't know.
I am a Moneylife member since last 5 months. I have seen your recommendations for the mutual funds twice during 5 months. Mostly they are one or same stocks are the same mutual funds are paying. Sometimes it is 1 or 2 or 3. But why are these totally different from, say, Economic Times recommendation?
You have to ask them. You have to ask them, not me.
Why should be so different? None of them are
Some people have bought JM equity fund, you know that? That minus 5% category is some of those. There are 45 equity mutual fund houses in this country. 47 maybe.
See, this it's a very interesting presentation. It's a fairly novel approach. I want to know. I have only one question. See, return on capital employed may be high, but supposing the valuation is very high. See, these can be very expensive stocks. Should we look at that, or the fact that the mutual funds have already purchased these stocks?
If you want to know everything in a single session, that will be very difficult. You have hit upon the right issue. And everybody knows this. There's nothing secret in this. Growth at a reasonable price. GARP. Value at a reasonable price. Everybody knows this. That you not only would look at quality stocks, but you would look at quality stocks at a reasonable price. The reason that portfolio that I referred to, the reason that portfolio did so well was, of course, the fortunate in terms of timing. If you see this particular portfolio, it's not our picks. These are stocks chosen by the top funds. Don't forget that simple fact that we only looked into the portfolio and we said these are the super stocks, pick them up. The reason that they have done very well and far better is because we don't care about the size of the company. Irrespective of the size of the company, PI Industries is a tiny company in front of SBI. Torrent Pharma is a small company in front of SBI. Shriram Transport Finance is a small company. Irrespective of the size of the companies, of course we didn't go, it's their own selection, so there's no small cap or all that in their fund, so we couldn't go any further. But the most important point is that all these stocks have been selected not just in terms of return on net worth, because there are other stocks also. Why only these? Okay. If you exclude what we have excluded further, because their prices were reasonable relative to the return on capital employed. So if you buy something which is expensive, you have to wait. You have to be disappointed for a short period also. If you are able to buy something which is high quality at a reasonable price, that's where a little bit of research is needed. And I come back to this point again and again and again. If we can do it with 2.5 people, I don't know why funds with crores of rupees at their disposal, attracting the best of the talent from all over the country, they can't do it. I have no clue.
You have not spoken about TTK Industries, Supreme Industries, Kaveri Seeds, Kajara Ceramics.
I have not spoken about many stocks because I'm not talking about stocks over here.
It is not timing the market, it is timing the market which will bring you wealth.
Yes, thanks, correct. Any other question? Yes.
We appreciate you're not telling us the stocks. You said I can't. But can you tell us the sectors which will negatively perform like
Sure.
commodities and petroleum.
Commodities will
probably
never
is-
perform for the long
Yeah.
term. See, you have to fix your approach and your objective. Objective is to make money over a very long period. Objective is not to make money for 3 months, 4 months, 3 years also, 5 years also. It is pure economics. It's nothing to do with stocks, markets, finance or anything. A company that is borrowing at 11% or 12% or 13% and is making on the money invested in the business and is making money at 9% is a value destroying company. It's common sense, no? The banks are lending at 11%, let's say. You take the money at 11%, then you have shareholders' money also. You not only have to make more money on the bank, but also risk capital which shareholders have invested. You have to make 13 or 14 or 15 or whatever. Commodity companies on a 10-year basis, 15-year basis, a very brief period of 1 or 2 years when they make super profits. Purely on demand supply. Nothing to do with their business. Because for some reason supply is less than demand. External reason. So the companies themselves don't know when they are at the beginning of that kind of a cycle. Then there are these large number of public sector companies, whether it's BHEL or Coal India or State Bank or whatever. There's a difference, you would admit, between the President of India as the owner and Nestle and Unilever as the owner. The ability to employ people, business compulsion, targets, quarterly targets, promotion, expansion, all of these things are far better handled by a private sector than by the government. It's a simple fact of life. Once again, those are the value destroying companies. So to come back to where to look at, you have to look at companies where return on capital is high. And these companies currently come from sectors like consumer products, private banking. Private banking is in private sector owned banks, like a Kotak Bank or a HDFC or Axis or whatever. Software companies, no matter what the problems are, the return on capital employed is 20-25% every year. They pay taxes, no debt. Then there are these pockets, smaller companies here and there, which for some reason they are in a very, very strong Amara Raja batteries. Only one other competitor, Excite. Amara Raja is managed much better. 2 suppliers of batteries in India. So there are these pockets also. So overall 4 sectors: pharmaceuticals, private sector banks, FMCG and software. And then a whole lot of other companies which individually are excellent. In auto ancillary, there will be a company which has a very specific advantage, who have managed overseas expansion very well. Motherson Sumi. There will be a company like Suprajit Engineering, based in Bangalore, king of cables. All the cables needed inside a car, they are exporting. There are companies which are, there's a company in Kerala, of all places, which is the world's number 2 in children's garments. World's number 2. It's going to be number 1. Kitex garments. The stock has just got up like this. So there are these pockets. Most of them essentially are export oriented. That's like a 5th sector. So Indian companies which are exporting to big names, what else do you need? Why? I mean, you can't do any amount of due diligence that a General Motors would be doing. If they are buying from an Indian auto ancillary manufacturer, you can imagine the amount of research and due diligence. This is their business. They are not portfolio investors. They can't put any damn thing in their car. There are damages, etc. So anybody who's able to sell to global names have 2 incredible things going for them. They have the world as their market, so it doesn't matter whether Sonia Gandhi comes back as a prime minister, or sorry, as a leader running the country. It doesn't matter to them. So all of these things will shake other people. But these are on a secular. In fact, if the economy goes down, rupee will be weaker, and these companies are going to do even better. So the fifth sector, which is export-oriented Indian companies selling not commodities, not gems and jewelry and diamonds, selling to large multinational names, because they've gone through enormous trouble to get into that list through global competition.
But sir, just one, when you said about RO and W, return on, what do you think about this replacement cost concept, what they have? These companies have very high assets. So don't you think that also plays price in the pricing?
No. Replacement cost doesn't make sense.
You mentioned the list of equity funds one should not invest, and what about the debt funds one should not invest?
This is not the forum for debt funds. I'll do a debt fund press separately. We will discuss that. Okay. Thank you so much.